This is the CRE Weekly Digest by Lightbox, a firm transforming the commercial real estate landscape by connecting every step of the CRE process with comprehensive tools and data. I'm Dianne Crocker, and I am here with Manus Clancy. Welcome to this week's episode. All right, Manus, let's dive in with the news developments this week. Once again, the bond market is driving the conversation. Treasury yields have come off their recent peaks, but the message from the market is hardly reassuring. We've got the 10-year still hovering around 4.7%. The 30-year remains above 5%. We got a curveball last week when the Treasury Secretary stepped in with an expanded bond buyback program designed to calm that long end of the curve. And so yields initially dropped, but they climbed right back up again. Stocks are feeling it too. The rally stalled a little bit as higher yields took some of the starch out of the market. On the consumer side, July new home sales plunged 10.5% from June and 6.3% from a year ago. That's their weakest pace since January. Consumer confidence slipped again in August. That fell 0.8 points to its lowest level since January. And that decline was largely because of lower expectations for future business and labor market conditions. And then lastly, of course, there's inflation. The Fed's preferred PCE measure rose 0.2% in July, 3.7% year over year. That was slightly hotter than expected. So, Manus, what I want to ask you first is this. Did DC's intervention in the bond market underscore just how hard these forces are to control? Do you think it helped? Do you think it backfired?
Well, I think given the scale of the move, that the benefit from the announcement to the trough that we saw in the 10-year was only about 5 or 6 basis points. I think you'd have to say that this had de minimis impact. It's a little surprising because in the past, when the Fed has intervened, we've seen much more notable moves, 10, 20, 30 basis points at a time as a result of these buyback programs. This time, the impact was really muted, just a couple of basis points, so little that Treasury Secretary Bessent had to come out and say, I have a lot more ammunition than this original buyback that we announced, and that helped a little bit more. But the velocity these days, or the momentum, if you will, on interest rates is higher. That nothing we seem to do right now, whether it's a cool CPI print or an even cooler PPI print, none of that seems to be satisfying bond investors, that they are concerned that the next move in inflation is higher. The PCE number yesterday was not terribly comforting. And I think this is the area we're going to live in until such time as we see oil prices start to decline.
Yeah, exactly. And I think, as you said, like the yields on the long end, they've been surging. Big considerations there are like the soaring AI-related debt issuance, higher federal deficit spending, and a buyback plan isn't going to touch either one of those drivers. It's kind of like a plumbing fix that doesn't really affect the bigger plumbing problem. And I also wonder, too, do strategies like this buyback expansion, do they undermine the Treasury market credibility and maybe squander an opportunity for kind of more long-lasting reform? But I think you're right. I think the message for the market after this week is we are stuck with high yields for, at least for the near term until oil prices come down.
Well, I think you bring up a really important point that this week we passed the $40 trillion level in overall debt in the U.S. And I do think that offset some of the Treasury's moves, even though what difference is there between $39.5 trillion and $40 trillion? Really, we're talking about splitting hairs at that point. But I think psychologically, there was a lot of reaction to, goodness, we have doubled the amount of debt in this country in the last 10 years or so, going from 20 trillion to 40 trillion. And I think that got a lot of news coverage over the last couple of days. And it made people re-examine where we are in our financial conditions. And to touch upon your metaphor, the plumbing metaphor, there is something to that when the Treasury intervenes and starts a buyback program, perhaps when our debt is 10 trillion or 15 trillion, maybe it makes more of an impact than when you're at 40 trillion. That, at that point, whatever you're doing, you're just trying to empty a bathtub with a teaspoon. And I do think we have fundamental reform that has to happen in our spending, but neither party seems willing to want to tackle it.
Manus, I thought for sure you were going to come back with an 80s rock song reference that tied in with that plumbing analogy.
I wish I was that quick. I wish I could come up with it. There's probably one in there, to be sure. But the thing I would point out also, you mentioned two data points a moment ago. One is about housing and another was about consumer confidence.
Yeah.
I think the least surprising thing was that both numbers were anemic, that these are really tied to interest rates. We're seeing the highest mortgage rates we've seen in a long time for single family acquisition. So there's no surprise that that part of the market is on life support right now. And confidence there has been really terrible for a couple of years now. And on the other side, when people see interest rates going up, affordability becoming more of a challenge because of higher interest rates, higher oil prices, it's also no surprise whatsoever that consumer confidence is lagging. So they go very much hand in hand.
Yep, they definitely do. And looking collectively at the week's market headlines, where you end up is inflation that isn't cooling enough. We have a labor market that's losing momentum. And like you said, consumer indicators are showing signs of fatigue and lower confidence. And now we have bond yields that aren't moving. Thoughts are going to the September Fed meeting. They have a difficult decision ahead. I always like looking at the probability of rate cuts. And right now the markets are putting roughly a 64% probability on the Fed holding rates steady at the September meeting rather than hiking. So I guess that's good news. Warsh speaks at Jackson Hole at the end of this week, but based on his previous comments, I don't expect we'll get any hints about what's going to come out of the September meeting. What do you think, Manus? You think they'll hold?
I think they will hold. I think that enough people have come out now and said, like Mark Zandi, we talked about him 2 weeks ago, coming out saying a rate hike would be adding pain on top of pain to the U.S. consumer at this point. I agree with that. I've said that over and over again for the last 3 months. So I think they hold, but my predictive skills are, I would say, right in the middle of that bell curve. I am, certainly not an outlier with my accuracy on the positive side. So we will see. I do want to bring up two other things that I guess are somewhat bullish. We've talked a lot about the bearish part of the market, the negative consumer confidence, higher interest rates, lack of impact of the Fed moves. But let's talk about a couple of positive things. Last night, NVIDIA came out with their earnings. The earnings were very, very strong. NVIDIA stock jumped after hours last night. The NASDAQ up this morning about 1%. So maybe we see another leg up in the equity markets, which always seems to make people feel better when their 401ks are improving. So maybe that is a little bit of a balm this week. And I don't know about you, but I seem to get the sense that there was a little bit less hostile narrative between the U.S. and Iran over the last week, that maybe these economic sanctions or the threat thereof are starting to work, that I saw a headline that we're starting to send diplomats back to the Middle East, that there seemed to be less shooting there. The White House, which, who knows if this is trustworthy or wishful thinking, but they said all the mines have been removed from the Strait of Hormuz. Maybe, let's keep our fingers crossed, maybe this is an inflection point. Maybe we are, instead of just talking about peace, that we are on the cusp of a deal. I don't know. For me, it just seemed like the headlines weren't quite as negative. It didn't seem like there was active shooting in the Strait this week. It didn't seem like other countries were getting lured in like they were a month ago. Again, maybe I'm just pie in the sky right now, but that's where my head is on this last week in August.
Yeah, I hope you're right. I think I'm just getting conditioned in the spirit of self-preservation, of not getting too hopeful with any one day's headlines. But you might be right. And it brings to mind something that I read a month or so ago, and I forget where, but it was a prediction that what's more likely to happen in Iran is not a credible peace agreement, but more of a kind of gradual de-escalation in the conflict. So maybe we'll start to see that happen and kind of take shape over the next month or two. And as we've talked about many times here, as that happens, the expectation is that oil prices will readjust fairly quickly. And I think the market would breathe an enormous sigh of relief.
I think you're onto something there. I think that when this thing started, to use a medical metaphor, I think many of us thought this was like a bad flu, that it was going to come on and we'd have to deal with it for a couple of days and it would be very annoying and painful. And then it would be over. And I think now, people are coming to the expectation that this might be more like a long-term chronic condition that we have to deal with it over and over and over again, like asthma or something like that, that it flares up and then it goes away and it flares up again. And I'm no expert here. As our listeners know, I've been wrong on this front for quite a while. I thought this would be over quickly, but I remain hopeful. What else can you do?
Yeah, I know. Very true. And it just makes forecasting so complicated. So it's definitely the biggest wild card in the market right now. So I think everybody would be relieved if, we started to see even a gradual de-escalation in the tension that has really gone on since, for how many months? 6 months? Going on 7?
Going on 7, that's right. And, I do have sympathy for people in our market. To be sure, I don't want to sound callous. I have a lot more sympathy for our soldiers that are serving in the Middle East and the poor folks in the Middle East that are just victims of war, that are finding difficulty getting food and water and so forth, not for anything that they've done, but because their leaders have chosen to do, right? This is always the way it is with war, that decisions are made by certain people, but the people that suffer are really just collateral damage. But when you talk about the CRE markets, we started the year with a lot of hopefulness that this was going to be a great year. And while it hasn't been a terrible year, it's been a challenging year, that the economic activity that we wanted to see in sales, in refinancing, in new development, it's been nice, but it has certainly leveled off, as you know, in the last couple of months. And it's hard to make decisions when you're not sure if the next move in the 10-year is another 50 basis points up or another 50 basis points down.
Right. It's challenging out there to make the numbers work, and the uncertainty of not knowing what the rate path ahead is. We haven't talked about rate hikes in a very long time, and now that's on the table.
The one thing out of Jackson Hole I think will be interesting, and I don't think this will come up, but we always refer to that PCE number as the Fed's preferred inflation measure. Mm-hmm. But now we have a new Fed chair. I'm sure that was Jerome Powell's preferred measure, but will it be Warsh's measure, or will it be something else that is more impactful? As you suggested a moment ago, he plays it very close to the vest, so we don't really know. Does PCE move the needle like it used to, or is it just kind of another data point for the new chairman?
For the analyst, the fact that he's very vocal about not releasing any kind of forward guidance or any indication about where it's headed. So that leaves the analyst to really parse his every word, and do word counts, like what word did he use more than any other, and kind of read way more into it than it probably deserves, just because he's not giving them much to work with.
I think it must be very hurtful for these Wall Street analysts that they used to be fed everything and now they're being told you're on a need-to-know basis. It's a very different world now. Dianne, what do we have for this week's Data Dive?
Yeah, so for the Data Dive, I dug into the transactions data that your team collects. And we've been talking a lot on the pod over the past couple of weeks about these huge multifamily deals. So I took your suggestion and I looked at multifamily buyers from the first half of this year who have invested more than $1 billion in multifamily. So I'll give you 4 names here. At the top of the list by far, with $3.5 billion in one deal, is Affinius Capital with Vista Hill Partners. Number 2 is the Scion Group with $2.4 billion and 2 multifamily deals. Number 3 is Bridgepoint Group, $1.4 billion in one deal. And then 4th is RMR Residential with $1.1 billion across 4 multifamily deals. So those are the top 4.
And that was for the first half of 2026, you said?
Yep, I stopped it on June 30th.
Okay. My inspiration for that question had been the fact that we've now seen 5 or 6 really sizable acquisitions by BGO being the former Bentil Green Oak firm. And they have been on a tear themselves. In less than 30 days, I think they're now up to 4 or 5 acquisitions in the Pacific Northwest. A couple in Seattle. It totaled, if I remember correctly, $350 million. Another in Portland. I think there was another in Hillsboro, Oregon, and then one in Southern California, the West Apartments in San Diego. So I think they will be on our list for sure, maybe even occupying the top spot in the second half of the year. A real vote of confidence for them, both in the property segment at a time where rates are high and in certain markets, Seattle, Portland, the Portland suburbs, and Southern California. So good on them for diving in and deploying capital at such scale.
Yeah, definitely. And I'd say you mentioned the second half of the year, them making the top spot, but I bet if I ran this exercise year to date at the end of August, they would be over the $1 billion mark for sure.
Well, it's funny that I look through our analyst work really every few hours. I want to see what is moving. Is it industrial? Is it multifamily? Is it office? What markets are moving? And our team does just extraordinary work keeping up with this. And by the way, you could see this now in real time. It rolls out on our Lightbox Live. Every time we get word of a new sale, big or small, whether it's by news or public records or a press release or broker research, we are revealing it here, and we are trying to contextualize it in terms of price per unit, price per square foot, and it rolls out. You'd see it changing every few minutes as they come out. My shameless plug for the day. But it's funny with BGO that I kept seeing their name on there, and my first reaction was to say, oh, our analysts have put the same transaction in more than once. Like they saw the same thing and repeated it. And with each one, I said, oh no, that's another 9-figure acquisition by BGO. And there's been many of them, I think a half dozen at this point since the first week in August.
Wow, that's really cool. That'll work its way into our August transaction tracker analysis.
Absolutely. And with no further ado, once again, how about we go into the Did You Know?
Sure. So I'll detour a little bit into what I did last weekend, and then it winds up being a Did You Know and a bit of a shameless plug for Lightbox. But I just got back from a camping trip in the Redwoods last weekend with a group of women that I've known only from inside conference rooms for many, many years. And it was my first time on their 6th annual trip. And Manus, I'm not really a big camper, but this was a tent camping trip. I used my dad's old one-man tent. And it was interesting because all the other women there were residents of California. So things like wildfires and earthquakes are a part of their lives that they're not really for me as a New Englander. But they took me on a hike along a trail on the San Andreas Fault, where you can see this fence that broke and the two segments kind of shifted 20 feet apart during the 1906 earthquake. And the women I was with are environmental risk managers from major banks. So as we were hiking along, the conversation turned to Sanborn maps. And Liz Lago-Marcino was with us. And Manus, I'm happy to say she's also a loyal listener of the podcast. And she pointed out that the Sanborn maps that were made just before the 1906 San Francisco earthquake and fire captured the city in like this near perfect, like street by street detail right before the disaster struck. And that there's no photograph from that era that even comes close. So the Did You Know is that Sanborn maps date back to 1867. And listeners may not know, but they were created purely for insurance underwriters. So it's funny by today's technology standards to imagine a surveyor walking block by block with paper and pencil, documenting building footprints, the construction materials, color coding them for fire risk, whether it was like a brick building or wood frame. And today's Sanborn maps are a key historical record that environmental consultants rely on in nearly every environmental site assessment. So that's my lead in to mention that Lightbox is in the midst of this huge project to improve the readability of our Sanborn collection. And I've seen the before and after, and the difference is incredible, especially on the ones like in San Francisco that were drawn more than 100 years ago. So I want to give props to Kathleen Lavallee and her team for making these historical records even more valuable.
I know in our New York office, we have a huge book which says Sanborn maps. And I would say it's probably 2 feet by 3 feet. You have to put the book on a table to actually turn the pages. And I've never looked through them in detail, but it is an amazing historical set of information, what you have in there. It's really extraordinary. But I do have to say that this was, or it sounds like this was an incredibly intellectually robust camping trip. This was more than just campfire, s'mores, and a snipe hunt. This was talking about the environment and best practices and actually getting some exercise in, doing a hike. It sounds like you covered a lot more bases than smashing together some marshmallows and Nestle's chocolate.
Yeah, there were some more, I will say that. Yeah, it was interesting. I mean, I didn't know much about even controlled burns in wildfires. The redwoods were incredible, but you could see the burn marks because of those efforts. So it was really interesting to talk about that. It wasn't your typical campfire chatter for sure. definitely time well spent.
And I should point out two things on the forest fire front as I take a brief detour. First of all, as always, our hearts go out to the people in Washington state that have been suffering over the last couple of weeks. That something I should have mentioned a couple of weeks ago, that these things are terrible tragedies for people. And to see the home that you raised your children in burn down has to be heartbreaking. And there's loss of life and there's loss of property, and our hearts go out to them for sure. My second point is adjacent to that, and that is shortly our team here will come out with some interesting academic studies on the impact of that area, what has been impacted. And we do this all the time. The team here has done incredible research on the Southern California fires, largely to talk about what is there, what are the environmental risks, what do people have to be concerned about in the aftermath of a tragedy like this. So it's a little bit of a preview of what's coming. I know they're working very hard on that. And when it does come out, I think it'll be a worthwhile read for people that want to know beyond the headlines, how people have to deal with things like excessive chemicals that are used to put out fires, or the runoff of things that have burned down from industrial factories and things like that. So more to come, a little bit of a preview. We're looking forward to putting that out in the next week or two.
Yeah, I'm glad you brought that up. It's important work, and I feel like the thinking and the research around the environmental impacts of these fires, just in terms of the debris that falls after on properties in the impacted area, is work that's really taking shape. And it's important to make sure that when folks go back to these areas, that public health is being protected.
I mean, I'm no expert by any means, but I do know that there's been talk before that the foam that's used to put out fires is concerning. And of course, we want to put out fires and we want to make sure that there's no loss of life, but this has to be dealt with after the fact, and it's an issue.
Definitely. Okay, Manus, do you want to switch to the transactions that caught your eye this week?
Well, I will refer quickly to one of the BGO ones. It was the most recent one that we saw. This is in Portland, as I mentioned. Savannah at Reed's Crossing sold for $160 million. This is a 300-unit property selling for $530K per unit. And as I mentioned, I think that was the fifth multifamily property that they had acquired, spending over $700 million thus far in the process. The next one, Greystar offloading the Elan Yorktown apartments in suburban Chicago. The property faces a mall, which is under foreclosure. This is the Yorktown Mall, again, in the Chicago suburbs. The buyer of the multifamily property, RPM Living, along with New York Life, the sale representing $335K per unit. Reporting there, by the way, Emma Whalen of The Real Deal. In Austin, Texas, where you don't get a lot of property comps because of the non-disclosure option that buyers and sellers have, there, Providence Management acquired the Beck at Wells branch for $86 million. This is a 576-unit property. Reporting there by CoStar's Walt Elmar. And lastly, Cushman & Wakefield brokering a $131 million sale of Edison Lofts in West Orange, New Jersey. This is almost $400,000 per unit.
A nice mix of stories. I want to add to the BGO mention, because I did read that deal in Portland, the Savannah deal, was part of a much bigger acquisition. The Savannah deal was one piece of a $953 million four-property acquisition for Holland. So that alone nearly puts it at the $1 billion mark that we talked about before.
That's right. A lot of these acquisitions do come from Holland, and they've been getting reported in onesie-twosies over a couple of days, but they have really added up.
Our two-time past podcast guest, Ryan Severino, is at BGO, so I'm starting to think we got to get him on here to talk about their multifamily tear.
I'd love to know why now and what they're seeing in these markets, because they are certainly not casting a wide net. They've really honed in on that Pacific Northwest.
Yeah.
And maybe this is a story of kind of like the Chicago market that overlooked during COVID as the Southwest and the Southeast really caught on fire. And now people are realizing that there's gems in these neglected areas. We should have him back, because I think he'll have some excellent insights into which markets he loves and which ones still remain quite challenging.
For sure. And you mentioned Chicago. This week, Intera Realty came out with a stat that the Chicago suburban multifamily market saw an increase in sales volumes during the second quarter of 67% year over year. So, between the Pacific Northwest and that, there are definitely some multifamily hotspots that are rising to the surface and getting attention from investors.
To be sure, what we're seeing here is that there are hot spots and there are cold spots, even within the same market. Going back to Seattle, we saw a headline just the other day, Cascadia at Fairwood Landing in Renton sold for $47.5 million to Bridge Partners. That was actually 22% below where it sold for in 2022 at $61 million. So we like to point out these hotspots and where people are plowing in money and we're seeing appreciation. But you go to Florida, you go to North Carolina, you go to Arizona, and you're still seeing things selling for 20% below where they were 4 or 5 years ago. Let's not kid ourselves that all of this pain is gone. And it's certainly moving slower now that the 10-year is at 470.
Right. Very true. And you just gave me an idea for a data dive maybe for next week, because the data set that I get from your group now allows me to look at the prior sale price. So it's so much easier now to look at those differences previously and the current selling price and lean in on which metros are seeing the most appreciation versus those that are seeing the most pain.
You see it everywhere. The two most predominant places are office and multifamily. Hotel, retail, to some degree, you've seen higher rates take the valuations to sharply lower levels. But in the office, not unusual to see a property that sold for $100 million in 2015 sell for $30 million or $40 million now. We're still seeing plenty of that. Probably not as much as we saw last year or the year before, but it's still happening. And in terms of magnitude, lots of properties that were selling for $100 million in 2022 in the East Coast or West Coast of Florida, the suburbs of Phoenix, $100 million in 2022, and now $80 million today, right? We're still seeing lots and lots of that. A couple of industrial sales that we have of size. I'll start again in Texas because we don't get a lot of comparisons there. The first one, Taiwan AI, a tech firm, acquired 2 Dallas area industrial buildings from Core 5. The price tag there, $108 million. That represents $166 a square foot, reporting from CoStar's Cannon Grant. The other one in North Carolina, a CBRE affiliate acquired a property in Mooresville, North Carolina. This is the North Carolina Commerce Center. The acquisition price, $135 million. The seller was Blackstone, and the number there, $150 a square foot, reporting by The Real Deal. And I'll let you comment on these, Dianne, but I do have a hot take on each one in a moment.
What a great teaser, Manus. I'll say on the first one, we talk a lot about the billions that are pouring into data centers, but, that story struck me as another side of the AI boom, and that's the manufacturing ecosystem that grows up around them, kind of the halo effect. So the bigger number that jumped out in that story was $919 million, because that's how much the buyer ultimately plans to invest in this campus. It's going to become their North American headquarters. It's got an advanced manufacturing and R&D operation. So this isn't a story of a hyperscaler who's buying ag land for a massive data center. It's an investment in the supply chain that supports the AI build out. And I'll give you a fun fact, Manus. That project was originally reported under the code name Project Plum Blossom.
That's a long name to have to repeat in whispers at the cafe. A one-word thing, might be a little bit easier to keep under wraps. I don't know. But my takeaway for this, my hot take was, in the first sale, the first one we would take a grain of salt, right? $166 a square foot. If they're going to invest another $900 million, that makes the 166 a little bit fuzzy. The second one, $150 a square foot. Those seem to be kind of modest prices for me. I've become accustomed to the $250 a square foot, $300, $350. Right. We all remember 10 years ago, industrial would go for $40 a square foot or $60 a square foot. And then it broke 100. We said, wow, this market's on fire. And then 200 and then 300. These prices seem kind of modest. And it made me wonder, are we starting to see a leveling off of what people are willing to pay for industrial after what is now a 10 or 11 year bull market.
Yeah, it's definitely in a period, I think, of rebalancing after a huge boom. And like you said, a spike in the prices per square foot. I haven't seen the latest averages, but you're right. These are two that kind of hover around that 150, 160 square foot average.
3 stories that are adjacent to this. The first one, Amazon to invest $6 billion in a new data center campus in Shreveport, Louisiana. That reporting from Real Estate Business Online. So just another geographical area where a hyperscaler is going to put shovels in the ground to build a new data center. That's one. In the industrial side, Trammell Crow and Daiwa House, they're looking to break ground on a 700,000 square foot industrial project in Southwest Houston. So people looking to develop new things. And then my third story, I really want to get your take on this. I can't remember who the reporter was on this. I wish I did because it was a great story. A new report sheds light that in the Chicago area, hyperscalers have gotten $100 million in local tax breaks across 3 communities for data center development at a time where property taxes on Chicago area homeowners are near all-time highs. And that seemed to really strike a nerve. This was not, we don't want data centers because it's going to push up our energy costs. This is, oh my God, these hyperscalers that are minting money are getting tax breaks. Dianne, I have to ask you about this.
Yeah, that's a big ouch for the Chicago residents, right? That's got to stir up some opposition. And we've already been talking about the fact that data centers are facing more and more pushback from affected communities. And this story sounds like it's just going to stoke the fire in Chicago.
I would feel quite outraged at what I would consider corporate welfare. And it moved quickly, that story. I believe it was Senator McCormick from Pennsylvania. It could have been him or it could have been the governor of Pennsylvania coming out very quickly and saying there should not be tax breaks for Mag 7 companies to build data centers. That is not where we should be going as a country. And I kind of agree with that, right? They're not huge job producers, these data centers. They are usually staffed by small teams. I think it's a different kettle of fish if you are making a tax break for an organization that's going to hire 5,000 factory workers in your area and help grow the tax base. I think it's a different story with hyperscalers and data centers.
Yeah, that one's not going to play out well in Chicago. I imagine we'll be talking about that weeks or months from now when the fallout comes to the surface.
Certainly, it's something to watch.
So we'll close out with a slice of life. What do you have?
Well, I'm going to start with Dolly Parton, and I'll take this in 2 directions. I want your thoughts on each. The first is just real admiration for how Dolly Parton carried herself throughout life. And pleasant to be interviewed, pleasant to watch on television, incredibly generous with her wealth. She created this philanthropy to give books to children to help them read. I've never met anybody who would say a bad word of her. And just, I would say, an example for how leaders in this country, celebrities in this country can follow, right? That you never heard her say a bad word about anybody. And I'm sure that if you're in the entertainment industry, there are times when you're frustrated. You're frustrated with your team or your agent or your manager or your venue where you're performing. And yet it was never a soapbox moment where she's yelling about this person or that person. And I knew people are passionate. There are people passionate in the entertainment world, or political passions that run high. But she was just such a person that revealed that you didn't have to lose your humanity or your dignity along the way. And I'd like to see other celebrities maybe make the same points without losing their minds.
Yeah, I agree. It's a good point. And I think that, all the points that you just made really speak to how loved she was across the spectrum. It was hard not to like her. She was uniquely herself. I do think that one story that gets lost when people talk about her is that she was a very shrewd businesswoman at a time when that wasn't that common, especially in the music industry. I read a story that Elvis wanted to record one of her songs, and his manager, Parker, who was documented in that Tom Hanks movie, wanted half of the royalties for her song into perpetuity. And she said, no, my royalties are for my family after I'm gone. And she stuck to her guns, and he never recorded it. I think one quote that always sticks out in my mind that I heard her say was that she never minded being called a dumb blonde because she knew she wasn't dumb and she definitely wasn't blonde.
That's pretty good. Well, that leads me to my question for you. And it's this for the slice of life. I talk about this with my buddies periodically. We all have a guy or a gal that we've listened to our whole lives. And when it comes time for them to either hang up the microphone for the last time or they move on to the next big show in the sky, it's heartbreaking, right? For some people, it was John Lennon. For some people, maybe it'll be Mick Jagger. Do you have somebody in that realm that when that person goes, when they hang up the microphone, you're going to say, wow, I am so sad today?
I gotta say, I'd answer Bruce Springsteen just because his career has spanned decades. I always admire not just a musician, but like a true poet behind the lyrics. All of his songs just speak to the humanity. And, he's gotten very politically active of late, but his lyrics through the years have just always reflected where we are as a society. He's still going strong, but when he hangs up, I'm going to miss him.
It'll be the end of an era.
Yeah,
for sure. And certainly puts on a great performance, I have to say. So I do have buddies, though, that I know that they might walk around in black for a year with a veil over their face when Paul McCartney goes. I think that I rue the day when that happens because I know that there'll be a pall cast over my buddies that will take a long time to shake.
Yeah, definitely. Music's so powerful. It's like I said, it reflects where we are as a society. So it's always hard when one falls off the landscape. So, all right, Manus, that seems like a good place to wrap up. Thank you to our producers at Bruning Media. Be sure to join us next week as we drill down into the news headlines, deals, and developments of the week. You can listen on all your favorite podcast platforms and send your comments or questions to podcast@lightboxre.com. As always, thank you for listening and have a great weekend.
Let's go.